Hello, everybody. Hello, and welcome to Private Equity Rundown. I am Bill, the company's expert. Thank you for joining me today. It is, I believe, Good Friday, so happy Good Friday to everybody out there who cares about that kind of thing. This is the live stream I do on a weekly basis where we talk about higher level business stuff, in particular, private equity. And what we've been doing the last several weeks is we've been kind of systematically exploring some of the foundational principles behind corporations and business and leading up to the concept of private equity. Today, we are going to be doing probably the biggest detour we've ever done on this series so far. The title of this episode is called Options Demystified, a deep dive into financial derivatives. So this is sort of my introduction to that kind of stuff for people who don't really know about these. You don't know what they are. It's been a long time since I kind of thought about this kind of stuff, but it's been a good refresher for me. So hopefully you're here to learn all about that kind of stuff, even if you have just a passing interest in it. A special shout out, as always, goes to my YouTube channel members, my super thanks donors, my Patreons, and to you, my participants. Thank you for being here. This is technically a Q&A, so get in the chat and ask me some questions. I'll help you out if I can. I'm going to cover the topic of this episode first, and then we'll take some questions at the end. I see there's 18 people here. Thank you for joining me. And you'll have to sort of bear with me because I'm a little bit under the weather today, so I'm struggling with that. But I did do some preparation for today instead of what I usually do, which is just sit down in front of a camera and start talking. Usually it's I am not prepared to an embarrassing degree, but today I actually put some notes together. So instead of like the whole, kind of I have to talk about something, I'm a little more prepared. Let's see if I can talk the talk here. So welcome. Okay, so we've been talking about all kinds of committees and stuff. Today we're going to talk about something, and this was actually requested by a viewer. Okay, now I've done that in the past where someone says, "Can you do a video on this?" and I do it, and that person is long gone. That's been my experience. So I don't know if that person is going to be here today to witness what they started, but we'll see. Okay, so options demystified, and of course we're talking about financial options. You may have heard of these in 2008. Or I'm sure we're going to be calling it 2008 at some point in the future. But 2008, there was a financial meltdown, partly caused by these things, financial derivatives. And it brought that kind of stuff to the forefront. And then it sort of disappeared after a while when things kind of recovered. But they were popular for a brief moment then. So you might be familiar with this stuff in that context. The other context you always hear about this stuff, and options in particular, are in terms of executive compensation. So it's in the news that a CEO got stock options, and most lay people are wondering what the hell are stock options. So that's what we're going to talk about. Okay, so let's dive in without any more ado. So we're going to talk about something called a derivative. A derivative has a very kind of confusing academic definition. I believe the academic definition of a derivative is something that takes its value from an underlying asset. Okay, so it's not worth anything in itself. You can't discuss it in itself. It's something that relates to an underlying asset. And there are many different types of derivatives. Options are one of them. And I figured that what we'll do today is we'll start off with a little illustrative example of what exactly is an option. And hopefully this is an example that pretty much almost anybody can understand, hopefully, if I've done my job correctly. Okay, so let's dive into this. So let's use an example everybody might be familiar with. If you have a car, you go and you fill up your car at the gas station. Okay? Now, the problem I have is that I'm in Canada and we use liters and Canadian dollars. Okay? If you're in the US, you use gallons and American dollars. And that's kind of consistent with using the most intuitive unit of measure for everything, which is probably calculating speed in furlongs per fortnight or something like that. So don't worry about the units. This is just a concept. But you understand that gas prices fluctuate on a daily basis. One day they're up, one day they're down. When they go down, everybody's happy. When they go up, everybody gets upset. Some people get really upset and they take it out on their fellow human beings, right? Okay. But never mind about that for right now. The idea is that gas prices go up and down. Now, let's pretend, for the sake of our example here, something simple. We have a vehicle and the capacity of the fuel tank is 100 liters. Yes. If you're in every other country but the United States, you'll understand what a liter is. If you're in the US, you may not know what a liter, you have never heard of what a liter ever. It's like a gallon, only smaller, okay? So your fuel tank capacity, your gas tank, is 100 liters. And to keep it simple, let's pretend that the price of gas is $1 a liter. So if you got to fill up your tank, that means you need 100 liters of gas. That means you pay $100, okay? So hopefully that's clear for everybody, as I've lost half my audience. Let's see if we can understand that. So it costs you $100 to fill up your tank. That's 100 liters of gas at $1 a liter, $100, okay? Now, let's pretend the next day gas prices fluctuate. They go down. So you show up the next day. Let's say you've driven your car about 1,000 kilometers, which is who knows how many miles, and you need to fill her up. You need a new tank of gas, right? So you go the next day, and gas prices are 90 cents a liter. So instead of $1, which is 100 cents, they're now 90 cents a liter, okay? So that's good. Gas prices have gone down, right? And it's cheaper, right? So that means that you only need to pay $90 to fill up your tank because you're paying 90 cents a liter and you're buying 100 liters of gas. Hopefully that makes sense, okay? Now you go back the next day, the day after that, and gas prices have fluctuated further. They've gone up to $1.25 a liter. So you're paying $1.25 for 1 liter of gas. So that means it would then cost you $125 to fill up your gas tank. Okay, so hopefully everybody's with me so far. This should be very, very basic. Okay, now let me explain to you what an option is, a financial option. Okay, try to imagine that you could then buy a coupon, and the coupon said this is good for 1 liter of gas. So if you want to buy 1 liter of gas, okay, and if you show this coupon to the gas station attendant, okay, you can pay $1 for this liter of gas. So that means for this liter of gas, you will pay the price of $1 a liter if you show this coupon, okay? Now, let's talk about the implications of this. Let's also pretend that the coupon it costs you, say, 5 cents. Okay, so you can buy these coupons at the gas station. So one day you go and you buy 100 coupons, each of them valid for 1 liter of gas. And that means that for those 100 liters, you could only pay $1 per liter. So that means 100 liters of gas would cost you $100, right? Now, is this a good thing? The coupon is an option. It says, if you show this coupon, you can pay this rate for gas, okay? Do you have to show the coupon? No. But if you choose to show this coupon, or to shoe the coupon, if you choose to show it, then you only pay this price, okay? Now, what's that coupon worth to you? Well, it's tough to say if you don't know what the price of gas is that day, right? Let's say today the price of gas is 90 cents a liter. What's that coupon worth? Where if you show it, you pay $1 a liter. Well, it's worth 0, right? It's actually worth less than 0. Why would you show that coupon if you're already paying 90 cents? You're paying a lower price, right? That doesn't make any sense, right? But let's pretend that today gas prices are $1.25, so $1.25 per liter, right? What's the coupon worth to you? Well, if you bought, let's do the math here. And I want to go to my notes because even though I could do this just ad-libbing, I did write it down, so I want to take advantage of that. That's how selfish and petty I am. But it's Friday. It's Good Friday, so it's a good time to do that. Okay, So for 1 liter, a coupon costs you 5 cents, right? That's the price of the coupon, right? So if you were to show the coupon, gas really costs you $1.05, right? Because gas costs $1, but you had to buy a coupon, so it's really $1.05. That's the new price you're paying, right? Now, if you didn't show the coupon, you'd be paying the prices at the pump, which today is $1.25. Okay? So if instead of paying $1.25, you're paying $1.05, you've just saved yourself 20 cents on 1 liter of gas. So that's the value of the coupon. The coupon, if you show it today, is worth 20 cents because it saves you 20 cents over the price you'd be paying at the pump, right? Hopefully that's clear. Okay, now if you extrapolate this to buy 100 liters of gas, that means that at the pump, you'd be paying $125 to fill up your tank. If you show the coupon, you're only paying $105 to fill up your tank. So you've saved yourself $20 on gas that day by showing the coupon. Okay? So the coupon, 100 coupons are worth $20. So that's like an option. Okay? You can't say what the coupon is worth without talking about what's the price of gas today, right? The coupon gets its value from the underlying asset, which is the price of gas in this case. Okay? So that's the idea. Okay? So the other thing is that it's not an obligation. You don't have to show the coupon or shoe it. You don't have to show it if you bought it previously. You can choose not to show it, right? Let's say gas prices go down and it's 90 cents a liter. It would be better for you to not show the coupon. You'd rather pay the pump price, right? It would be cheaper. Okay? So you don't have to show the coupon. It's a right, not an obligation. That's very important when we talk about derivatives. Okay? There's one further thing I'll say about this whole coupon example, and that is that let's say the coupon is for, like we said, if you show this coupon, you pay $1 for a liter of gas, right? Well, if gas prices are currently more expensive than that, right? It's $1.25 or higher, $1.50, then you would say that the coupon or the option is in the money. Okay, because if you show the coupon, first of all, you'd want to show the coupon immediately, and it's worth something, right? But let's say today that gas prices were below $1 a liter. It was 80 cents or 75 cents, right? This coupon you have where you show it and you pay $1 for a liter, right? You don't want to show that coupon right now because right now the gas prices are less than $1. So you would say that that coupon or that option is out of the money. Okay? The only reason you would buy that coupon when it's out of the money is because you're protecting yourself against future uncertainty, future volatility, right? You don't necessarily want to use it now to get an advantage. You want to keep it just in case prices go up, and then no matter what, you're not paying more than $1 for a liter of gas, right? That's the idea. So in that case, you would say that the option is out of the money. And if gas price is $1 per liter, same as the coupon, you say you're at the money. Okay. So anyway, I'm actually going to maybe not do any of this lingo type stuff. It'll be easier, I think, to get through this. So hopefully everybody understands what an option is. An option is like a coupon, right? It's a right, not an obligation. It takes its value from the underlying asset. And the reason why you would want these and why these might be good is because you might want to protect yourself against the volatility of the price of the underlying asset, like gasoline. If prices all of a sudden skyrocket, you're covered. You got a whole bunch of these coupons, right? Okay, so that's an option. Now, an option is a type of financial derivative. Derivatives are anything that takes its value from the underlying asset and it's not worth anything in itself. And there are many different types of derivatives. I've dealt with some of these. I haven't dealt with all of them in my career, but so some of these I'm kind of talking more theoretically or academically about it. But the ones I want to cover briefly today are forwards, futures. We already covered options, warrants, and swaps. Okay. You might have heard about swaps. They were publicized. Many years ago in the Great Recession, right? In the credit crunch or the financial crunch of 2008, whatever you call that, whatever the official name of that is. That was kind of a big thing that was in like the media, on the forefront of everybody's mind. Credit default swaps in particular, because they were like some of the culprits that led to this big market crash that they had back then. Okay, so forwards, futures, warrants, options, and swaps. We already sort of covered options. Let's go through these. Now, some of these are rights, like an option. It's not an obligation. It's a right. Okay. But others are obligations. Okay. And we're going to start off with forwards and futures, which are very, very similar. Okay. Probably the place to start would be with forwards. These are obligations. These are not like, you have the option of doing something. These are like, no, we're going to do it. We have a contract to do it. So forwards are agreements to buy something on a certain date for a certain price. So it's like a buyer and a seller that sign an agreement that say this, the buyer says, I commit to buying this thing from you on this future date for this price. And then the seller says, yes, I agree. I agree to sell you that on that day for that price. Okay? That's a forward. Okay? Now, what's a forward worth? Well, you can't really talk about what it's worth unless you talk about what's going on with the underlying asset, right? So, for example, just like we talked about a coupon for buying gas at a gas station, okay, as an example of an option, we could also talk about forwards for gas prices. You could say, look, I buy a lot of gasoline. I'm not just someone who fills up their car. I'm a company. I own a fleet of trucks or 18-wheelers, and I buy lots of gas. Okay, and because I'm a sort of high volume customer, I'm an institutional customer. I'd like a special arrangement with the gas company. Okay, where we enter into this agreement. Okay, and I want to protect myself from the volatility of gas prices. They're always kind of going up, going down. I don't like that. I like things that are predictable. I like knowing what I'm going to spend in the future on what thing. And it also puts my mind at ease because, almost like insurance, I know that whatever happens, this is going to be the price, and I'm guaranteed to have availability of gasoline. Okay, there won't be an issue where, there's a run on the gas stations and the gas stations don't have any gas and I can't buy any, right? So I want to secure my future supply. I want to agree on a price and I want to get it all in writing. So I know what's going on. Then I can plan, right? Because otherwise, if I didn't know, what's going to happen precisely, I'd have to keep money in reserve as like a just in case kind of fund, right? And I don't like doing that. I'd like to free up that money if I can, right? So let's enter into a forward contract. So I'm going to go to the gas station. I'm going to say, look, instead of buying 100 liters, I'm going to buy 100,000 liters. And I'm going to pay this price, and I'm going to buy it on this date. And you're going to agree to sell me that. So you negotiate the stuff, and then you sign, okay, we could sell you this much for this amount. And you enter into agreement where it makes sense for both of you. Okay, and that's a forward contract. Gas stations like it because they are assured that they will have a buyer, and they can actually set the price a little bit higher to compensate for any uncertainty, right? So as long as you set the price properly, the buyer and the seller will agree that it makes sense for both of them because it takes the uncertainty out of things, the variability. So that's a forward. Okay. Usually these are done one-to-one between the buyer and the seller, right? Let's talk about futures. Futures are very, very similar. Now, you may have heard about futures. They're talking about them in the news. Okay. Futures are exactly the same as forwards, except that it's a little more formal. It's a little more standardized. Okay. So futures are essentially the same idea. The only difference is how they're traded. Okay. So what they do is they standardize, the forward contracts. It's usually by standardizing it. For gasoline, you could say it's always for a certain amount, for 1,000 liters of gas or 1,000,000 liters, whatever it is, right? They'll standardize that. And instead of having just a 1-to-1 ratio between the buyer and the seller, just working this out, you do it on an exchange, like a stock exchange, only for futures. Okay? Some of the popular stock exchanges for futures are things like the CME, the Chicago Mercantile Exchange in the United States. There's the London International Financial Futures Exchange, LIF or LIFE, however they pronounce that. There's a couple others. There's ICE. There's a few others. But you do this on a stock exchange. And the idea is that if any one party defaults and doesn't honor their commitment, whatever their commitment was, there are consequences because you are a member of an exchange, right? So there's further guarantees that people are going to honor their commitments, right? If it's just 1-to-1, one of the problems is that, sometimes people just say, nope, screw it, I'm not doing that. I know I said I was going to, and I know I said I was going to in writing, but you know what? I can't, so never mind. And that erodes a lot of confidence in doing forwards, right? So futures are a bit more standardized and regimented and controlled and regulated. So that's the idea. Okay, so right now I know that with a lot of trade stuff going around, there's a lot of activity in the futures market where different countries or companies are committing to buying or selling different things in the future for certain prices. Okay, so we've covered forwards, we covered futures. I'm actually going to move this around and talk about this in a different order because the other type of financial derivative that is an obligation as opposed to an option are swaps. So forwards are an obligation. Like once you sign a contract, you're expected to do it. Futures are the same thing. Once you buy and sell futures, you're expected to honor them, or there's consequences. Swaps are the same thing. They're an obligation. Okay. Now swaps work a little bit different. Okay. As the name implies, it's like two parties, like a buyer and a seller, right? Usually. But instead of like one person buying and the other person selling, you get two entities that agree to exchange something. They swap something. So my understanding for like I'm not down with the latest like financial stuff that they're doing because this stuff is evolving all the time. But traditionally for swaps, there were two reasons, as I understand it, traditional reasons why you would do a swap. One is to protect, and you're protecting yourself against different kinds of risk. One was things like exchange rate risk, okay, like foreign exchange risk, in which case you would swap currencies. So, one party agrees to pay in one currency, the other party agrees to pay in a different currency, right? That kind of thing. The other one was interest rate risk, right? So, how you can decide whether you want a fixed interest rate or a variable interest rate? And fixed is good in the sense that it's predictable, but it's not good in the sense that you end up usually paying more for something that's fixed, if your interest rate is fixed. On the other hand, variable is usually better because most of the time you end up paying less, but it's worse in the sense that it's volatile. Like you don't know what you're going to be paying. And, sometimes things go up, things go down, they swing wildly. It's hard to predict, right? You can't predict it. So it's volatile, it's unpredictable. That's the downside to a variable interest rate, right? So one of the things that people mitigate this with is they do a swap, okay? And as I said, it's a financial contract between two parties where the parties agree to exchange cash flows over a certain period of time, okay? Now, if you're trying to protect yourself from exchange rate risk, you could swap a fixed interest rate cash flow with a variable interest rate cash flow, and the other party agrees, to get the cash flow. So one person bets that prices are going to go up, the other one bets that prices are going to go down, and they agree to swap, right? And the reason they did this is because there's tax implications and all kinds of other things. Instead of just paying each other the cash, they swap the cash flow. Right, and then the other one was the currency exchange risk, where like one person, you're exchanging currencies. One is paying in US dollars, the other one's paying in euros, right? So that shields you to a degree from, wild swings in exchange rates. That's the idea. Okay, so they're obligations, they're contracts, right? And I haven't really dealt with swaps personally that much. I'm not really the person to talk to for swaps. You could probably tell that. I'm just sort of going off the theory. But let's talk about the other two types of financial derivatives that are the major types. Okay, we already discussed options. Let's go deeper into options, okay? So we started off with the example of a gas station, and we talked about the coupon. It's like having a coupon to buy gas. That's like an option, okay? Where we don't have a contract, where we said we are going to use this coupon and we are going to do something. It's having the right to use the coupon if we feel like it, if it makes sense for us. Just because we bought the option does not necessarily mean that, we're going to call the option or we're going to use the option, okay? Okay, so an option is a financial contract. It's the right but not the obligation to buy or sell at a specific price within a set time frame. Oh yeah, the other thing about the coupon that I didn't say in my example is that there's also an expiry date on the coupon, right? So you could say this coupon is only valid for the next 6 months. Beyond that, the coupon ceases to have any validity. So poof, it's gone. So if you paid for that coupon, that option, it evaporates after a certain amount of time. Obviously, the longer the time frame, the more the coupon would be worth, right? Okay, so we talked about that. Now, there's something really cool about options. At least I think so. And I have used this. It's something called real options, right? Where you extend this type of thinking, not just for pie in the sky financial stuff, but for real stuff that you do, okay? Now, let me paint a picture for you. Let's say you're building a house, okay? We all love that kind of thing, right? You get to deal with construction workers, that's stimulating conversation, right? Highly intelligent people. It's wonderful. And they tend to drink Tim Hortons coffee, which I don't understand. I drink Tim Hortons coffee, and I think it's terrible. It gives you joint problems. It makes you feel horrible, and it tastes bad. So I don't know, but they love it. So whatever. Anyway, you're building a house, and you're putting in the foundation, okay? So the foundation goes under the ground. Now, if you want to build, say, a one-story house, you only need a small foundation. The concrete or whatever you use can be very thin. Doesn't have to go very deep, right? But if you were building a two-story house, okay, you would need a stronger foundation. The concrete has to be thicker, it has to go deeper, right? Because it's carrying more weight. So even though your house is the same sort of length and width, right? It's the height that's kind of variable. You could, have a building that's the same length and width, but instead of being one story, you could build it 4 stories, right? Now, the problem is if you are building a house or any kind of building, you might only need 1 story worth of space now, but there's a chance that maybe in the future you might need more space, in which case it would have been nice if you had built a 2nd story to your house originally, right? Now that's okay, because if you build a 1-story house now, you can always extend it. You can add a 2nd story on top, assuming your foundation will support the weight of 2 stories, right? It is possible to upgrade a foundation, but that's very expensive. It's not something that we typically do. So when you're building the house, you could look at the size of the foundation as what they call a real option. It's like the coupon, right? It costs you more to build a beefier foundation that can support 2 stories. But let's say you only need 1 story now. So you decide, okay, you know what? I'm building the house now. For me to, we've already dug a big hole in the ground and we've got the concrete truck here and, we've got everything ready to go, it would really not cost us that much more to build a beefier foundation now. We got everything here. It's only like just maybe 10% more cost to put in a beefier foundation now. Okay. If on the other hand, we want to save money, we want to we don't want to go above and beyond for anything. Just the cheapest thing is what we want. The problem then is that if you later determine that you end up needing more than 1 story of space, you would have to beef up the foundation. It's a much bigger cost. So originally, your incremental cost for going from a small foundation to a big foundation was only 10% more. But if you build the entire house, wait a couple years, then realize you got to put a second story on top, you got to upgrade the foundation, and that's going to cost you 4 times as much. So huge increase. You got to excavate again, you got to change out the foundation while the house or the building is still in place, which they do, which is really cool if you've seen that on TV. With hydraulic jacks, they jack up the house, and then they remove all the foundation, then they build a new one with concrete and everything, and then they drop the house back on top of it. It's really cool. Okay, so you could think of it's almost like we have a coupon. You pay 10% more for a beefier foundation now, so you have the option of not paying a much bigger cost in the future if you should decide to upgrade your house, right? Now, we're not talking about financial instruments here. We're talking about a physical, real decision, and that's called a real option. And I think that's really cool because I've employed that kind of thinking where what you're doing is you're actually calculating. You're calculating values of how much does this real option cost us and what is it worth? And you're doing it with mathematics as opposed to just, gut feelings and, where you actually estimate what's the likelihood of needing to upgrade the house, what's the cost involved, what's the cost if you did it from the outset with the beefier foundation, what's the cost if you did it later, all this kind of thing. Okay, so that's where this type of thinking can make its way into managerial decision making. And you're not dealing with financial instruments, you're dealing with real business decisions here. Option A, option B, right? Now, that brings me to the next thing I want to talk about, which is very closely related. I believe it was, I wrote this down somewhere, but it's not in front of me. I think it was in the 70s. They came out, a pair of mathematicians came out with, they discovered exactly how to value an option, at least as it relates to the financial instruments, right? The financial derivative. It was Black-Scholes, the Black-Scholes option pricing model. And it's like a formula. It's like a formula you would learn in high school or something. It's like a little bit of algebra, right? And if you plug in all the numbers, right? What's the price? What's the probability of this? What's the strike price and all that kind of stuff? It'll calculate. It'll say, this is the value, right? And the idea is that that's the value. If you keep playing this stuff over and over and over again, it tends to approach that value. If it's just a one-time only thing, it could still be wildly inaccurate. But yeah, it was I remember calculating this in university or something. It was area under the curve, under the probability curve, and all this kind of stuff. But that's what they came out with. So, you can actually calculate the value of an option precisely. So you could involve this in your financial decision on whether you should build a beefier foundation to a building, for example, by using the Black-Scholes option pricing model and inputting, the costs of the building and the costs of the house and all this kind of stuff. So without doing what we sort of did before, which was just sort of taking a guess in what your gut feeling is, you can actually apply some data to this and calculate, okay, if the price is more than this, then it makes sense. If the price is less than this, or the likelihood is less than this, or the time frame is less than this, or whatever, then it doesn't make any sense. So there you go. So that's options. Really, really cool. It's an interesting idea that applies to financial instruments that you can certainly also apply to real life, to real business decisions, and use this type of thinking to apply more than just to outside the realm of like banking and finance. Okay, and then the final derivative I want to talk about today are warrants. Warrants are options. They're a right. They're not an obligation. And we encounter this sometimes when you're dealing with executive compensation, stuff like that. Warrants are issued by companies, and it's like an option. It's like a right to buy the company stock at a certain price. So as you can imagine, this comes into executive compensation. But the catch, the thing that makes it a warrant, okay, is that you're buying shares of the company, but the company issues new shares to compensate for the ones that now have gone to you. So this has some implications. First of all, even though you're buying shares, the amount of shares available from the company doesn't change because they lost a few to you, but then they issued more. The other effect is that the value of your shares and all existing shares have now been diluted a little bit because they created more shares. Right? So this affects the value of existing shares. So that's like one thing they use in executive compensation I know of. I'm sure it has other applications too, but that's where I've seen it. But it's like an option where you have the right to do this, but you don't necessarily have the obligation. You don't then have to buy the shares at that price if you don't want to. Okay, and that kind of concludes my sort of overview of this. We started out by doing a sort of real-life example of what an option is, which is one type of derivative. And then we talked about the other major types of derivatives: forwards, futures, we already covered options, warrants, and swaps. So there you go. So that's kind of for the person who requested this a couple of weeks ago. They said they would love to hear my take on this. So there you go. This is probably the furthest afield we're going to go from an actual talk on private equity, okay? Because although it is relevant to discussion, this stuff does kind of come into play, it is a bit removed from it. So next week, we're going to come back to more of the private equity discussion. We covered the different aspects of a corporation. I'm not sure what the topic is going to be, but we're going to bring it back into the buying and selling of businesses, which is what private equity is. Okay, I'll briefly open it up to questions if anybody has any questions, and then we'll probably wrap this up. Just a reminder, if you are interested in learning business and you want to learn it from me, this was probably not a great example of it, but because I was doing it off the cuff more or less, but check out that course, my $100 MBA. So best bang for the buck around. If you choose to go fully deep into that course, it's actually more of a program than a course. You will learn everything that you can learn in a brick and mortar MBA program. That's one hell of a boast, but it's absolutely true because you are reading the same source material, the same textbooks that you would be reading in a full-blown MBA program in places like Harvard Business School in their MBA program. You're getting a reading list, and then I'm guiding you through it. So this is great for people who want to take an MBA or are thinking of taking an MBA, but just want to put their toe in the water to see what it involves if they are really into it. It's great for entrepreneurs or people that want to learn the concepts, but don't really need to impress anyone with a fancy piece of paper. And it's good for people who just want sort of cursory overview of business without going in depth into it for years and years. That's maybe a bit more than they're wanting, but they are wanting to learn the essentials. Or maybe they're interested in one or two topics. They're interested in marketing and accounting, but couldn't give a rat's ass about organizational theory, HR, economics, innovation, all the other areas that you study, operations management. So if you're any one of those type of people, this course is for you. So check it out. There's a link in the description. I am back every Friday to talk about private equity in this live stream, Private Equity Rundown. It's a little bit of an experiment for me. I wanted to do something on this topic, so I just sort of grafted it onto my main YouTube channel. But I did that because I believe that a lot of the concepts in private equity, one can apply at a lower level and can benefit you in your career by employing some of this type of thinking. So that's the other basic reason why I do this here. I am back in a week with this. Now, I am also back in 20 minutes with my regular live stream where we talk about how to get a job, called Honest HR Nitrous, where we talk about the gritty reality of how some of that stuff works, and if you're between jobs and all this kind of stuff, like what to do. So you can join me for that. Other than that, check out my courses, and I will see you guys soon. And I will be back same time next week with another edition of Private Equity Rundown. Thanks very much. You guys are awesome. Take care.